So who here has long-term care insurance? Is anybody? And how have you had it for a long time? Yeah.
Yeah, we got it when it was a good price, supposedly, but now it seems like they're cutting back on the amount they're gonna give us. That's why I'm here, so.
Okay, great. Yeah, you'll probably be able to get those questions answered. And
Yeah.
then, how about reverse mortgages? Has anybody ever done that before? No? And anybody have people they know in long-term care now? At all? No? Okay. Well, that's good. Yeah.
You're all good and healthy. You don't need the help yet.
Hallelujah.
So, I'm Fritz. I met a bunch of you already, but we have 3 speakers today. One, Micah is from Right at Home Care. We have Richard Esterly from Capitas Financial, but what's your
Capitas.
Capitas, and what's the insurance? Is that the brokerage too? The insurance brokerage?
Yes.
Okay. And then Spencer Lewallen, he's from Davis Mortgage. He's going to talk about reverse mortgages and other mortgages if you have questions about those. Or HELOCs too, if this is an option too. But why don't we have them introduce themselves? We can start with Micah.
So I'm Micah. I'm the care coordinator for Right at Home, which is a home care company. I'll talk a little bit about the difference between home care and home health care. But what we specialize is the non-medical side. A lot of people don't realize that there's medical and non-medical services. So I'll be happy to answer any questions about what the scope of our non-medical side is and the services that we offer. There's a lot of home care companies out there. Some of the home care companies also do the medical side. So I'm just here to educate and answer any questions you have because there are a lot of options out there. So you've got to do your research to see what's going to fit your need as well as your budget. So happy to be here and get us started.
And I'm Richard Esterly, and I've owned, it's gone under a couple different names, but Capitas Financial is an insurance agency here in Albuquerque for 30 years. I'm part of a national group. So we have offices all over the country, and we specialize just in life insurance, long-term care insurance, and annuities. And so I'm a broker, so I represent literally over 100 different insurance companies. And so I'm here to help you understand the several different options that people have for long-term care insurance, or to answer any questions about existing long-term care insurance. So happy to be here.
I'm Spencer Lewallen. I've been in the mortgage business over 30 years here in Albuquerque. And as I've gotten older, my clientele has aged with me because I've helped them since they started buying houses. And now they're, a few years ago, started coming to be about reverse mortgages and how they can work. So I dug into that program to learn a lot about it, to be able to educate people because there's so many bad stories about it, and the way the program was when it started as to what it is now is completely different. And the idea for me being here today is how to fund either in-home health care or long-term care insurance using the equity in your home.
Perfect. And I'm Fritz, and I with Keller Williams. Vanessa Johnson is in the back here. She's one of our team members. And for Keller Williams Realty on the Riverside office. Hi, Steve. Welcome. I'm also a real estate planner, so I help people with figuring out ways to eliminate family disputes and minimize taxation when they sell investment property, and just help to build generational wealth. So that's kind of my specialty, and also a senior real estate specialist, and hence we started the senior program here. So, and one of the things about this is we don't do any selling at in these seminars, but everybody here has materials that you can certainly reach out to them later or afterwards at the end of this, and with any questions you have, and feel free to ask questions this time. So, first of all, I think we're going to start off with Micah a little bit. She's going to explain about a variety of different issues, ADLs. What were you talking about? Well, you go right ahead.
Sure, we'll just jump right in. I love that it's a casual format that we can do that. So a lot of people, when they start realizing that they need help and they want to stay at home, their first thought is, I'm going to reach out to my insurance company. The home care that we provide is considered non-medical, so therefore you cannot use your insurance. Hopefully in the future there will be some sort of reform that has some benefits, but until that happens, you're looking at private pay. So a lot of these companies are private pay. There are more robust companies out there that do the non-medical and medical side, but for instance, if you're gonna have OT or a physical therapist or a skilled nurse, that is medical. You would be able to possibly use insurance, but you'll need a referral. If you need something like shower assistance, you want meal prep, you need some transportation, or even just a little help around the house like light housekeeping, that's gonna be where we would come in and consider home care. So the health is not in that, it's just home care, it's personal care for you. But again, it can be very pricey. So there are ways to pay for it. However, you got to be aware that you need to meet certain criteria. Also, different companies have a contract versus a service agreement, so you'll want to be aware of that. You'll want to do your research basically and know maybe how many hours per week or how many hours per day you can afford or are required for that company. For instance, mine is a 3-hour minimum. If we're going to send somebody out, you got to be aware that they're going to at least be out there for 3 hours. Some companies require an 8-hour shift minimum, so that might be too much. Or it might be that you need 24/7, but again, when we're looking at a private pay, and right now the industry's anywhere between like $30 and $35 an hour private pay, it's gonna add up very quickly. The other thing you need to be aware of is some of us do contracts. We do a service agreement at Right at Home, but if you don't utilize all your hours and you're in a contract, then they're still gonna require you to pay for it even if you didn't get that help that week. So be aware of that pitfall. You can use like a long-term care policy, which I'll send it over here in a second, but you wanna be aware of the criteria there. Does anybody know what ADLs are or what that acronym stands for? So that's activities of daily living. And that's gonna be, again, the non-medical side, but it's help with bathing, help with, feeding, if you're gonna need feeding assistance. Even just getting up, so transferring, right, getting up from your seat, actually qualifies as an ADL if you need somebody to stand by and assist you so that you're not a fall risk. So you have to meet so many of those ADL requirements, though, for a long-term care policy to pay out, essentially. So those are the kinds of things I like to educate people about when they're researching home care companies, because you don't realize all the little details that you need to meet in order to actually get the full benefit of what you've paid for. I do have some other resources, and they're just conversation guides, like what do you really need? Are you looking for non-medical care or are you looking for medical care? So this is a really nice conversation planner. Also, I don't know if everybody's aware, but there is a downloadable resource guide from the city of Albuquerque, and it also has other services in there, all transportation. There's actually people who will come out and do some maintenance and landscaping once a year for you. So even if you need services that don't fall within our scope of care, because we're not gardeners, we're not landscapers, sometimes we get confused, like, oh, you can come in and you can clean my house and pull my weeds, and there is still some limitations, but there's other resources out there. So I wanted to let you know that the state, or the city of Albuquerque, I should say, actually provides free resources for those kinds of services if you're not affluent enough to pay for it yourself. So,
Do you guys provide any medical, do you have anybody on staff who does medical at all?
not with Right at Home, but that's where you'll wanna analyze what are your needs. Do you need a skilled nurse to come in and do wound care or give you injections of whatever prescription you're on? But all of that is gonna be considered medical. You've probably heard of like Amber Care. They're a bigger, more robust company, so they'll have and I hate saying unskilled because I take pride in our caregivers and I wanna build them up. They're very skilled. It takes patience and a lot of hands-on learning how to transfer people properly. But again, we're considered unskilled. So if you need the nursing and the occupational therapy, the physical therapy, make sure you're reaching out to a company that maybe can provide both. If you're just needing a little help around the house, that's when maybe home care, not the home health care, would be a better fit for you.
And if one is actually ends up in a residential or is considering a residential facility, a facility like a community facility, instead of staying at home, when do you guys sort of give that kind of advice, or
So we'll
or if you
actually
can
still come
choose?
visit you if you decide to move into an assisted living facility, because even though you have 24/7 staff that are skilled, you're also having 15 people on the same floor as you. And so if you're in need at the same time as 3 others, who knows how long they're gonna get to you. I hate to say that, but I've had a client who used their call button. It took 20 minutes for them to come help them out of the bathroom.
Okay.
So oftentimes, even when you're in an assisted living facility, we get calls for people to, so that we can come out and provide some of that one-on-one assistance that maybe the facility isn't able to render in a timely manner when your needs are.
Wow, I've never heard that before.
Mhm.
Yeah, interesting. Okay, well that's great. I guess that is a pretty good segue to Richard. We want to talk a little bit about, okay,
This has happened before.
is the motion bigger? So, how does one prepare for needing the services that Micah can offer?
Yeah, so importantly, there's 3 different types of long-term care, which I'll talk about in a minute. All 3 provide care for all levels of care. So care, as you were explaining, what we call intermediate care and then skilled care. So insurance policies pay for all types of care, whether that's in a traditional skilled nursing home or you're just receiving some help at home. And just to back up, everybody's probably aware of this, but you never know. So long-term care, there's not any insurance out there that pays for it besides long-term care insurance. Your Medicare doesn't cover it. Medicare might cover some of the costs in the first 100 days that you need long-term care if you come out of a hospital needing long-term care, but that's it. There's no Medigap policies that pay for long-term care. Your health insurance, medical insurance doesn't pay for long-term care, and that's why private long-term care insurance exists. So all of the qualified long-term care insurance policies, which are the only kind anyone should buy or even look at, I'm not even aware that there's any that aren't non-qualified, that the IRS doesn't consider qualified, so the benefits are tax-free. They all work the same. So, and I'll get into the 3 different types in just a minute. But if you need assistance with 2 or more activities of daily living, ADL, eating, dressing, bathing, toileting, transferring, or incontinence, if you need assistance with 2 or more of those, that would trigger the benefits to start to be paid from an insurance policy. Or any type of cognitive impairment, so dementia, Alzheimer's, anything like that. So how does that happen practically speaking? A doctor, your doctor, a doctor says you need assistance with 2 or more activities of daily living, or you have a cognitive impairment. So that's the way they all work. And you pick, so let me talk about the 3 different types, okay? There's traditional long-term care insurance, been around, 75 years or so. That is, we call it pay-as-you-go. If you need long-term care insurance, it will pay for your long-term care. If you don't use it, and you just pass away, there's no benefit. So it's kind of like your car insurance or your auto insurance, and that's not bad. I mean, you don't want to use your car insurance, right? You don't want to use your homeowner's insurance. So that's been around the longest, but in the last 10 to 15 years, there's been a 70% decline in people buying traditional long-term care insurance. And there's a couple reasons why. First off, most companies have gotten out of that business and into the other 2 types that I'll explain in a minute. And the reason they've gotten out of that business, And there's still some left. Mutual of Omaha is one that is pretty, you know, large in that space. But those policies never had guaranteed premiums, and so over time, those companies have raised rates, and it's really been a PR black eye in the insurance industry, because you have people, whether or not it was ever explained to them that their rates could go up, or they forgot, or who knows, they're getting these letters, as we had this lady mention, that your premiums are going up, or you keep your premium the same and will reduce the amount of benefit that you have. Now, these companies can't just do that arbitrarily. They have to file with the state of New Mexico. Insurance is looked over, you know, by the state, supervised by the state. So the state, our state insurance office has to look at it, and they have to justify, we're gonna raise rates on all people 70 to 75 or whatever, and we want 20%. The state can say no, the state can say yes, but only 10%, or they'll give them the full premium increase. You might ask why the state would even allow that. Well, the state's charged with, you know, making sure these companies have the wherewithal to meet the claims, while also trying to protect you as a resident of the state of New Mexico, or whatever state you bought the policy in. So that's traditional long-term care insurance. We've seen a sharp reduction in the amount of those policies sold. The other type is life insurance with a long-term care benefit, and those have been much more popular in recent years. And within that life insurance, there's two major types. There's something called asset-based life insurance with a long-term care rider, and then just a straight life insurance with a long-term care rider. So I'll explain the second one just generally. So you buy a death benefit of $300,000, there's a long-term care rider. If you need it for long-term care, you can draw down on the death benefit while you're living. To the extent that you don't use any of it or all of it, the remaining benefit transfers income tax-free to your beneficiary. So people like these type of policies because they feel like they're going to pay into something, and one way or another a benefit will be paid, either as a long-term care benefit or a death benefit. And most all these policies are guaranteed, so premiums can't go up. The other life insurance policy within the second group of policies is called asset-based care. It is a life insurance policy, but it has a very small death benefit and a large long-term care benefit. So it's kind of designed for somebody that really doesn't want or need the life insurance, and it's just going to provide a maximum long-term care benefit. So for example, you might have a death benefit of $100,000, but a long-term care benefit of $300,000. A lot of those are paid with a single premium, but you can pay over 5, 10, 15 years. The last type of long-term care in the insurance world is an annuity. And one would only consider an annuity if you couldn't qualify for either of the first two. Because both of the first two types, the company's gonna look at your medical record, maybe a paramedical exam. And annuities, there's 5 or 6 kind of knockout questions, but you don't get near as much leverage. Like you might put $100,000 in the annuity, and if you need long-term care, it might be worth $200,000. So you're not getting as much insurance, true insurance in that world. But for some people that can't qualify for the other two, that's better than nothing. So that's kind of a bird's eye.
And are those of both term insurance and whole life? I mean, or is that how they're set up? Or?
In the life insurance, realm, number 2, they're all permanent insurance, meaning universal life, whole life. Most of them are universal life, And, cause they need to be there not for a period of time, which is what term is, a term of time. It needs to be there until you're 80, 85, 90, 100. It needs to be there forever, cause you don't know when a long-term care event might.
Okay, so they're all whole life style.
Time, yeah, they're permanent, what we call permanent insurance.
What's their usual, rate of coverage? I mean, the percentage of coverage once you have it?
So they'll pay, what there is there's a monthly maximum benefit on all three types that you determine up front. Like a typical monthly benefit today, somebody buying long-term care insurance in any of the types, it's probably $5,000 to $6,000 a month. I have a handout over here that shows in Albuquerque what the costs are today, average cost in Albuquerque and in 10 years. So, you know, usually it's $5,000 to $6,000 a month. And I'll just add, and then there's two different types with all these policies. There's something called reimbursement and indemnity. Reimbursement, the insurance company reimburses you for the actual cost of long-term care each month, provided by a licensed long-term care professional, like over here. Indemnity is where they just give you the full monthly benefit each month, the $5,000 to $6,000. And a lot of these have inflation options, so that'll grow over time. But they just write you a check, you go do with it whatever you want. You get the full monthly benefit, and most people are gonna hire a licensed long-term care provider. But some people buy that because maybe, like I'm thinking of a guy that lived on a ranch and his daughter said, I'm gonna take care of you and mom. And so he thought, great, I'll buy indemnity and I can pay my daughter to take care of us. And she had been a nurse, so she was pretty qualified. But does that answer your question?
So what happened with your insurance? Like you have your, like the Medicare part and that, and if you need to go there, they don't collaborate with everything else, like that drops or what?
No, Medicare, with the one exception of maybe the first 100 days, nothing in Medicare or Medigap or any of that world will pay for long-term care. And sometimes people get confused. They start thinking of long-term care as kind of medical insurance, but it's really not. It's the cost of paying people to help
So
care
the
for
home
you.
care.
Getting from point A to point B, helping you eat, get in for a shower, a bath. It's not, once you're getting skilled care in a nursing home, then it becomes more medical care. But it's really early on, it's just helping you do the things you can't do to get around.
You mentioned limits, let's use the number 300,000. So theoretically, if you start that care in 5 years, that burns up and that policy's dead. Am I thinking about that right?
You're exactly right. So,
Because if you have a stroke, sometimes that's gonna go out beyond that 5-year mark. So at some point, you're gonna have to transfer to Medicaid? Or,
And there are no benefits with Medicaid for home care. Well, there are very limited, I should say. I know of one company right now that has an active contract. I know of two that did. One has an active one, but when you think about 1 out of 30 home care companies having that contract, you're very limited. So yeah, it's out there, but based on their staffing levels, if everybody's going to them, you're still gonna be in a situation where you might not be getting your needs or your preferred times covered for your self-care.
You're right though, that, part of that, well, how much long-term care insurance should I buy?
right?
That's the magical question, right, if we knew the future. So, my philosophy is, let's face it, there's a lot funner ways to spend your money than long-term care insurance. So I think you buy to the statistical average. I mean, you could buy $1 million policy, those are available, you can buy as much as you want, but that's not likely. Statistics say men will need claims for long-term care for men are about 2.10 years, almost 3 years. Women are more like 3.5 to 4. So I think that's what you plan for. Some people want to be more conservative and say, well, I'm gonna plan for maybe a 6-7 year. You can do that or shorter. But I think you look at cash flow and all the other financial things in your life, and then you determine something that's reasonable and plays towards the averages.
Yeah, and you know, you talk about 24-hour care. We've had to deal with that for a short period of time after say a hospital stay. And if you bought insurance with a $5,000 monthly maximum, and you have this whole policy, it covers a week of the month.
And we look at it from like a daily, right? So if it's 5,000 and we're looking at it at a daily benefit, you're only gonna get paid $161-ish per day of care. Well, at $35 an hour, that's barely six hours of care, right? So not even near what the cost of 24/7 would be.
And then, but the residential, that's at home. So if you were to move into a residential community or a nursing home, they're between $5,000 and $10,000 a month. Kind of thing. So it just depends on the services there.
And you say long-term care does not help to pay the cost for when you move into assisted living or something like this?
No, it's for services directly rendered to you, so the
In your
hands-on.
home, in your home.
Right, or even at the facility, because we actually have people who have long-term care, they're already in an assisted living facility. Again, they might not be getting the attention that they need, and so they're still using their long-term care. We're only coming in for maybe 3-4 hours a day, but they're still using their long-term care in an assisted living facility. But it has to be those ADLs, those activities of daily living, is the only thing they're gonna pay out on. So we have to document that we helped you in and out of the shower, we helped you out of your chair, we helped you, clear a catheter, whatever it is, yeah.
So you talked about the heirs. I mean the asset-based insurance, that would be more weighted towards the long-term care. But then if you were to die, then your actual heirs wouldn't be getting any of the portion that was dedicated to the long-term care. Is that how that would work?
Well, so yeah, there's the true life insurance one that has a larger life insurance benefit, and then the asset-based care has less life insurance. So really the way that works typically is that's usually like a single one-time premium and everything's guaranteed. So let's say you put in $75,000 one time, you can pay that over 10 or 15 years too, but most people seem to just do single premium. Then that might buy you $300,000 of long-term care that would also grow usually at 3% compounded annually. And then the death benefit though would be about $75,000. So if you died and you didn't use any long-term care, your heirs would kind of get the money you put in it, maybe a little more. It depends on the company, but it might be 100,000 or something, but less death benefit as opposed to the other one where it's more like 300,000 in death benefit. There's more life insurance in the second type.
Okay, and when's a good time to buy it? Earlier, or if you were to spend $50,000 when you're 40 and buying that versus when you're 60, is there a difference in the payout? How's that work?
Yeah, every year you wait to buy long-term care insurance, the cost will be more, just like life insurance. You run the risk of developing some condition that could prevent you from getting it, because they will look at medical records with the exception of the annuity approach. They'll look at medical records, and they're interested in things, like if somebody has rheumatoid arthritis, that's probably a no-go. Some of those things.
Dementia?
Yeah.
How would they evaluate of dementia? Are they doing anything special for people with mental illness?
Well, if somebody already has dementia, they're not gonna be able to get a policy, but if there's a family history, they could still get insurance as long as they don't have it themselves. The best time to buy long-term care insurance, most people buy it around age 65. It's kind of a retirement decision a lot of times. I'm retiring, you know, I need this or that, for retirement, and long-term care is included kind of in those decisions. So I would say, you know, the best, I mean, the earlier the better. 55 isn't unusual. 55 to kind of 70, you can get it up until age 75. Some companies even go to 79, but it starts getting pretty pricey when you get into your mid to late 70s.
Excellent, excellent. On the dimension, is there like a St. Louis scale that what it was? I can't remember. There's a variety of different scales that say, okay, they make a determination
Right,
as to whether.
Like the
This-
onset, and then you go to mild, moderate, severe,
But somebody's
yeah.
making a determination with some sort of text, right?
Yes.
Yeah. All right, cool. Well, thank you, Richard. So the question then is, well, what are some options of other ways to pay for it? Maybe you want to put down a $75,000 payment to get that long-term care that's a one-time deal. Well, Spencer has some options that would allow you to do that.
Well, one of the things to look at, if you have equity in your home, is use the equity in your home to fund that long-term care insurance. There's a couple of ways to access that equity. One is with a traditional home equity line of credit. The points about that is it's gonna have a payment attached to it. The draw period in terms of how long you can pull money out is typically 10 years. And as we all remember, the financial crisis back in 08 and 09, if you had a line of credit, a lot of the banks came in and just closed them down, or they reduced that amount. So there's a little risk doing it that way, but if you needed to pull out money to then pay for your long-term care, a HELOC, that's what that's considered, home equity line of credit, is one vehicle to use to be able to get the funds to pay for it. Another way is to use a reverse mortgage, in which you would have a line of credit that doesn't have a payment required, that can never be closed out, and that actually grows over time. So the unused portion of that line of credit will grow at whatever the interest rate is on the loan. If somebody taking out a $100,000 line of credit on a reverse mortgage right now, and they don't use it, they don't draw on that line of credit, it would be worth $107,000. Your limit would be $107,000 next year. So it's a tool to be able to access the equity you already earned, rather than having to go into your other investment accounts or whatever to deplete them to fund a long-term care insurance.
So you're telling me that if you have $100,000 that you can pull out of the equity of your house, you don't use that money, they have to pay you, what were you saying, 7% a year on that?
Yeah, whatever the interest rate is on the loan, and right now the rate's about 7%.
Yeah.
So it increases, what they pay you is it just increases your credit limit, if you will. In a year's time, that 100,000 that you haven't touched, now you have 107,000 you can access.
That's available to you. So it's like a line of credit.
And then let's say at some point in the future you decide, well, I'm not gonna use this at all, and it's grown from 100,000 to 120. If you sell the house, do you get that 120?
You bet, with the fact that you haven't used it, it's still equity in your home.
But that portion of the equity is actually going interest.
Yes, with the unused portion that you haven't used that line of credit, as long as you keep it open, it's gonna continue to give you more equity to access.
Is there a cost to keep that open?
Not to keep it open, there's a cost to set it up, there's closing costs and other fees with the reverse mortgage to set it up.
It's a little bit more expensive than a HELOC, but it also gives you these other benefits that could be very well worth it.
So it can never get taken away, that's the
But
big
it's a
thing.
variable interest rate, correct?
Yes,
So it can go up or down.
correct.
So
But
what
it's
happens if you die and your spouse needs to stay in the house?
He can stay there until he dies, or until he decides to maybe go into assisted living and sell the home. Once the last spouse or last person on the loan leaves the home for more than a year, then the loan is due and payable. So typically the heirs then will sell the house, or in some cases, they'll put a mortgage on it and refinance that reverse mortgage and have a new loan and keep the home.
Yeah, I mean, sometimes you don't want to sell the house because you'll be facing capital gains, and so if you are able to keep the house and rent it or use it as a vehicle to borrow the money, at that point, then you would be able to avoid the capital gains tax, and your heirs would have a step up on that value of the, if there were taxes, if you were facing taxes. Then you talk about 1 year, you have 2 years to sell a house after you've, how's that, so you have 2 years after one of the spouses has passed, you can still get the section 121 deduction for 2 more years. After that, it's $250,000 for each spouse. So, but if there's going to be a significant capital gain, like you said, that might be something you want to bless your heirs with, for instance, and then you figure out a way to keep it, even though you're in some sort of care and having care.
If you could clarify this equity term, let's say you bought a house 10 years ago for $300,000, it's now worth $600,000. So when you go to the bank for a reverse mortgage, the fact that it's increased in value by $300,000 is what it's worth. Is that also equity?
Yes, that
The increase in value will be considered equity by the bank.
absolutely, because the loan is based on the value of the home. And somebody who's 80 can typically borrow about 50% of the value. Somebody who's 70 can borrow about 40% of the value.
On a reverse?
Mm-hmm.
Yeah, and there are these myths out there that say, well, if I get a reverse mortgage on my house, I'll lose my home when I die, and my heirs won't get it. But that's not true. So
Right, that's a lot of the
no longer used to be true, right?
Well, when they first started in the 60s, it was done by a private bank in New England, and they made an arrangement with a family to share equity. We will loan you the money on your equity, but going forward, we get a portion of your equity. The way a reverse mortgage works now is just like a traditional mortgage. It's just a lien on the property. The homeowner stays in title, and it's your property, and your equity belongs to you. If you pass away, the equity goes to your heirs. So that's the biggest misconception, that people think the bank owns our home. They don't. It's no different than the bank owning your home on a traditional mortgage. They don't.
So this stigma against reverse mortgages is really not to worry about these days?
Absolutely. Since, actually it started with Reagan. When Reagan was in, that's when FHA, Federal Housing Administration, got involved in reverse mortgages to put in protections for the seniors. And then over time, they just added more layers of protection. For example, it used to be, when we did these, people didn't have to have good credit. They could be in bankruptcy and we could do a reverse mortgage. And now there's what we call a financial assessment. Is there enough money coming into the house to make sure, household, to make sure you can pay your property taxes and your homeowner's insurance and basic maintenance on the house? They don't want to set people up for failure. So that's a protection that was put in place. There's also a provision in there, what we call a non-borrowing spouse. Sometimes people will be married and their spouse is not of age to get a reverse mortgage, which is typically 62. That person can still be, they won't be on the loan, but they are considered a non-borrowing spouse on title. When the borrowing spouse passes away, that non-borrowing spouse can stay in the house. Before they put that law in, if you weren't on the loan, you die, your wife doesn't get to stay in the house, you have to sell it. So more protections have been added over time. And there's just an education process to get past the stigmas of, why are these bad? Let's dive into it and look to see and answer all those, because they really made it a very protected loan in the sense of it protects families. With every reverse mortgage, there's mortgage insurance. And you wonder, why, if I'm borrowing 50% of the value, why do I have mortgage insurance? That's to protect the family in the event that the loan balance, because it grows every month because you're not paying interest, the interest gets added to the loan. So if it ever came to the point in time when you live to be 100 and the housing market has crashed and the loan balance is higher than the value of the home, that does not come back on the heirs. That's what the mortgage insurance is for. So there's never a deficiency judgment. So lots of protections in there to to make this like, wait a minute, we've got our home free and clear. I need a couple $100,000 to buy long-term care insurance to cover us till we die. Maybe I can look at this and take advantage of that equity.
Well, you could use the equity just as another savings vehicle, because if you don't plan on using it, you can draw 7%, right?
Absolutely.
And if you did get a reverse mortgage, that equity in your house is just sitting there,
Correct.
it's not drawing anything.
Exactly.
It's not costing you anything, it's not, there's no
But
cost,
the cost-
there's
the
no
cost
interest
is
cost.
increasing anyway, so
Only if
you
you,
don't kind of
if
get-
you've borrowed from it. It's a line of credit, so if you don't use it, there's no interest
there is
costs.
Do people normally go to the bank that holds their note on the house to get this reverse mortgage, or do they shop around?
But people can shop around certainly, because you see Tom Selleck. I don't quite look like him, but I mean, they advertise, one of the big lenders. With them, you get a call center type environment, but there's also individual mortgage brokers like myself that specialize in this, that will come sit down with you and work it out to explain exactly how it works. And also give you the resources to investigate this, do your homework. And one other piece, there's part of the protections for homeowners is there's individual third-party counseling that's required. So let's say we talk about a reverse mortgage, you go, Spence, I'm interested, let's go further. Before we can even do the application, you've got to go to a third-party counselor and be counseled on a program to make sure that I haven't sold you a bill of goods and that you understand what you're getting into.
Is there a cost for that?
Yes, that's a cost. That's one of the only out-of-pocket costs, typically $125 to $150, and it can be done over the phone.
The other thing is you have to live in the house? Or
Yes.
can you do it on primary, like for property?
It is for primary residences only.
Primary is, okay.
And sometimes we help people that have wanted to buy a second home. One example was Angel Fire. Family wanted to buy a cabin in Angel Fire. Parents have been wanting to do this all their lives for their kids. They did a reverse mortgage, pulled the money out of their primary residence, paid cash for the house in Angel Fire. So that you can use the money for anything you want.
And then there's no payments, too.
Right, that's it.
Yeah. So, you talked about if the borrowing spouse, you mentioned, is that how you termed it?
Mhm.
Borrowing spouse, if they were to pass, then the other couldn't continue borrowing. Do they
They cannot take, they won't be able to draw any more money out. If they can stay in the house and not make payments.
do they typically, will spouses typically be on the loan together though? Is that
Yes, usually, if
normal?
they're both of age, they will.
Oh, you have to be of a,
62.
okay, that's. Got it.
And one
So
other
you have to
way,
be 62 to be able to get a reverse mortgage?
correct,
Okay.
there are programs out there that you can actually do it if you're 55. But the amount they loan is much less, and the interest rate is substantially higher, like in the 10-11% range.
Oh, wow.
Those are proprietary individual companies doing those loans, they're not government insured.
PhD and stuff like that.
Right.
Okay. All right, well, that's fascinating.
One last question, so in this reverse mortgage, you pull out $100,000, and let's say today the interest rate is 7% for 2024, and then come 2025, it drops to 5%. That's what they would accrue at, 5%.
Then you make 5% on it, yes,
But then it would go up to 10%, you'd get that,
correct,
so it can fluctuate.
right.
Is that based like a adjustable rate mortgage where they have a step up every year no matter what interest rate?
No,
Yes.
the rates will adjust, but there's a cap. You can never go more than 5% over your start rate
Gotcha.
In the term of the whole loan or in that year?
in the term of the loan.
Oh, wow, okay.
But does that work the opposite way? You start out with 7% with a 5% cap, it can't drop below 2%?
No, it protects you, you never be over 12. It doesn't, if, let's say rates go down to 2%, then just the interest you're accruing on your loan is based on a 2% rate.
Okay.
So the bank risk is similar to a conventional mortgage loan?
Right.
In a way. If interest rates were to go to where they were in the early 80s,
Oh, you
you
bet.
know? Yeah.
That's why we get it with the caps. Always
Yeah,
want to
yeah.
have something that we know we're protected on the upside.
I see.
So if you don't use it, on paper you gain, but you'll never get the cash until,
Yeah, if you don't use it and don't pull the money out, it just sits there as an emergency fund. Or like you said, another bucket of your retirement funds. You have social security, maybe a pension, and then you could actually access the equity in your home if you need it and not have to make payments on it. I've helped people that have a good retirement plan in terms of pension and social security, but they had a mortgage. This guy was a friend of mine. He goes, Spence, you mean I can get a reverse mortgage and I don't have my mortgage payment anymore? He has to pay his taxes and his insurance, but the principal and interest part of the mortgage payment, he doesn't pay. So that was like a pay raise for him monthly.
But it does lower the equity in his house every month too. On the flip side.
Right.
I've heard that if you have to go to assisted living or you have to move out of your house to be taken care of, they have you sell your house so they can have access to all your money. Or you have to sell your house so they can have access to your money.
That's a good question and one of those misconceptions. The way the rule is, if you have to go into assisted living and you're there for more than 12 months consecutively, then the note is due. Then you have to either sell the house or your children, for example, if they're your heirs, can come in and purchase the house.
But then on reverse mortgage, if you went that way before you ended up being in assisted living, what happens there?
Well,
They draw on what we accrued from.
Yeah, for example, if you were in assisted living, if you're in there for more than a year, the mortgage is due. So you'd have to either make arrangements to sell the house or somebody to pay off that loan. But the equity, like if you, because that's one of the big misconceptions. They want people to go into assisted living or pass away and then the bank gets a house and keeps your equity. That is not true.
So
It's in your name, and when you pass away, whatever you owe on that mortgage, when that disposition of the house is taken care of, sell the house, pay off the reverse mortgage, the remaining equity goes to the heirs.
or to pay for your.
And that's a great question, because that's one of those common misconceptions. Because of all the twists and turns you hear in the media or from people that, you know, one of the things I hear often is people will say, well, I knew somebody that lost their house because they had a reverse mortgage. Saying, well, tell me what happened. They didn't pay their taxes and insurance. And guess what? You don't pay your taxes and insurance, you have a regular mortgage, you're gonna lose your house. And then we all know if you don't pay the taxes long enough, the state's gonna take it. So it's just one of those, you don't hear the rest of the story.
So it's actually better to have your house in reverse mortgage if they're older and this could happen to you? Is that one of the reasons why you're pushing reverse mortgages?
Well, first I want to say I'm not pushing it.
Oh.
I just want to educate. That's a good term, because I do help people get them. But the idea is if you have your home free and clear, you have ability to put $100,000 or $200,000 in a line of credit that you may or may not use. Murphy's Law says when you need the money and you don't have it set up, you can't get to it.
Yeah.
Or to use it as a vehicle again to pay for the long-term care insurance. You could pull the money out, not make a payment on the money you pulled out of the house, fund the long-term care insurance, and not have a payment on that.
Right.
They all get settled out when you leave the home.
Or fund the right at home, the other part of the long-term care insurance does not pay. So we've just got the access to the cash.
We've done reverse mortgages for families where in one case the grandmother lived in her house, did not want to go into assisted living, she needed it. She was on 24-hour full home health care. It was like $25,000 a month. She owned a very expensive home down in Rio Grande. We were able to get them set up with a $300,000 line of credit because she still lived in the home. And that's how they paid for the long-term care insurance, or the home health care. It's crazy expensive.
And that's the medical side of it, right?
Right, when you say home health care, remember that's, we're looking
Sorry.
at nursing,
No, that's right.
skilled nursing. No, but it's a common thing. They call us and They're like, hey, I need somebody, but I need to do wound care and I need this and that. Well, again, it's non-medical. So we're home care. So just make sure when you're comparing companies, are you looking for home health care, or you need skilled providers, or is it just personal care or home care, where it's that one-on-one care for yourself? The meals, the transportation, the housekeeping, the showering assistance, those kinds of activities.
So, yeah, healthcare is when there's wounds or you have injections or.
Right, or, unfortunately you have diabetes and you need somebody to come and look at your sugars or this or that. I mean, there's so many medical conditions, right, that would require a nurse to come check in on you. And some companies do have, they're like an all-in-one. They have the home care and the home health care, so you'll be getting different people coming for different shifts to do whatever activities. But when you're thinking of home care, it's the non-medical side. So.
Well, let's say you have a spouse who has, some, let's say maybe cancer, and they're given by the doctor, you got a couple of years to live, but they don't want to go into assisted living for that, they don't want to go into a hospital. They would die in their home. Now they need injections, and you can call them a nurse to do that, but otherwise, for the pain, but otherwise, if they just want to slowly die in their home, that's not illegal, is it?
No, it's not.
Lots of people do it. I mean, I think it's upwards of 80% of people, have health care and stay in their home, age in place is what it's typically called. And a lot of people do that until they actually need to go to hospice, essentially.
Which also keeps you in your home, though.
Which can keep you in your home,
Yes,
yeah,
hospice
absolutely.
can keep you.
Now, is there any, when you differentiate between Medicaid and Medicare, I've heard some rumblings about a primary care provider being compensated by Medicaid to take care of his or her spouse at the home versus sending them to a care provider, managed care provider? Does that even exist?
Yeah.
You do need to get a referral from your primary care to use Medicaid. Now, if there's any sort of incentive on the back end for them to write that referral, I'm not aware. There shouldn't be, but I wouldn't be surprised.
But Medicaid's not really available unless you have, if you have any assets.
Right.
I mean, you have
I think it's $2,000 or
it's
less.
not significant. So
Yeah.
you wouldn't be owning your house at that point. I mean, you'd have to work through your assets before you're gonna be eligible for Medicaid.
Right, and that's where the revocable trust from the last couple of seminars comes in. See, I'm learning about
There
this.
you go, yeah.
It's all coming together.
So let's say, a spouse is given 2 years to live, and, to have in-house care from a licensed nurse for 8-10 hours a day, it would become extremely expensive. So not to have access, before all this starts accruing, can you give away all your assets to your kids or charities so that legally you have no assets, so you can qualify for, let's say, Medicaid, is it?
Yeah.
I think it's
you
2
have
years.
to have like a
Something.
5-year.
Yeah.
There's a
5-year.
So you're not,
You gotta do
It's a
it.
great idea, a lot of people have thought about it, so government said
But then
no.
if you happen to die before that happens, then they claw it all back.
Oh, they can't
Yeah,
qualify.
they
I
claw it back.
did that with my parents. We transferred everything years before.
Years before, it's 5 years.
Like 8 or 9 years before.
Perfect.
The home and stuff like that. But it's a burden no matter what you do.
Yeah, I mean, if you'd done that and they had gotten into problems after 4 years, that would have
Then
been.
that's not gonna happen. That's not gonna work.
So you're saying, if you see all these expenses accrue in a couple of years or so, you can't give away everything in that 2-year
No.
time.
Not
It would have to have been at least 5 years before they can claw it back. Man, they're always into your pockets.
Taxes.
If they come up with a good idea, they squash it.
I think that girl that was talking about the irrevocable trust, that has something to do with, you might be able to protect the home, the main home. I don't know. I gotta talk with her.
Yeah, you can never avoid death and taxes, right?
Yeah. Seems to be the case. And getting closer and closer. Here.
Cool. Anybody else have any questions? Let's see if I have any more questions.
Oh, I have a
Do
question.
you have any questions?
I have a question.
There you go.
Do all long-term care policies have that elimination period?
Yeah, so every long-term care policy has what they call an elimination period, which is usually, some of them you can get a 0-day elimination, which is no elimination period, but usually they have a 90 or a 100-day. And what that is it's the amount of time that you need long-term care that you're gonna pay out of pocket before the benefits, the insurance company starts paying the benefits. So it's like a deductible on your medical insurance, except it's a time period and not a dollar amount. And usually, most policies, it's gonna be 90 to 100 days.
So then if you come to me, I'd be invoicing you, I mean, depending on how they wanna pay, but yeah, I'd be invoicing you for, 3 months, and you'd be paying the company directly before you ever saw any reimbursement coming back from your policy. But some of them have a 0-day one, that's why.
Yeah.
But some of those
Be
policies
interesting to
don't
bring
cover
up.
your services anyway, is that correct?
Right, they'll only cover the services if we're helping with the activities of daily living side. So
Okay,
I can
got it,
come
got
in
it. You're
and do
right.
your chores and make you a meal, but they're not gonna pay for that, right? You have to allow me to help you with your socks and shoes, or
I understand.
stand by for safety, while you shower, something like that. More of
Yeah.
that hands-on personal care.
Importantly, so any of the long-term care insurance policies will pay for any type of care, and you and your family and your advisors decide where you want to have care. So you can have care. Most people want to stay in their home, right? So you can get care in your home. So with the insurance, it all comes down to, do you need assistance with 2 or more activities of daily living, or do you have a cognitive impairment? And if either of those are true, then the company will pay the benefits after the elimination period is met.
Do you find that as a couple, when you get into something like this insurance, that is the wife's insurance cheaper than the husband's insurance, because they're a lot smarter than us and live longer? And do you get a group discount for doing 2, or?
Yeah,
How does
no,
that
that's a
work?
great question. Actually, long-term care insurance, the traditional type, is more expensive for women.
Ah,
It's the flip of life insurance, because men die sooner and we don't need long-term care for as long.
right.
So yeah, it's actually more the true long-term care cost is more expensive for women. Now, when you buy the hybrid type, that's a life insurance with a long-term care, there's also life insurance, and men die quicker, sooner, than women, so it kind of gets averaged
It
out.
balances out, yeah.
There is, with traditional long-term care insurance, and this is one really good advantage to traditional long-term care insurance, is you can get what they call the shared care benefit. So you have insurance on the wife, insurance on the husband. It links the 2 policies together, so if you exhaust your benefit, you can now tap into your spouse's,
Oh.
and vice versa. And when one spouse dies, they leave behind their unused benefit, and the cost for their insurance drops off. So the surviving spouse inherits. And that's really, there's some drawbacks to traditional price increases, right? Which I anticipate will continue, not like every year, but I think that those costs will go up, but the shared care is a huge advantage, and we always recommend that for couples.
So if you get in at say 60, I'm sorry, go ahead.
So in this shared care, if you already had traditional long-term care for 10 years and you didn't know about this, you go to that insurance company, say, I want this. Is that gonna be an additional yearly charge?
They won't add it to your existing insurance. You'd have to reapply for a new policy, and honestly, now that you're 10 years older, it's just very unlikely to make sense, for, you know,
Did they have a shared care 10 years ago?
Yeah, they've had it for 10, 20, 25 years, shared care. Genworth, does anybody have Genworth insurance?
Yeah, right
Yes,
here.
we
Okay, yeah, they've had the most premium increases. And
Yes,
one
they
question I deal with a lot on policies I don't have anything to do with, we didn't even sell much Genworth insurance, but I've helped people. You know, you get those letters and it's always like, do I pay the increase?
I know.
Do I not? I'm tired of these increases. And we were talking about this before, you know, and Genworth's ratings aren't the best anymore either. Their financial ratings aren't that good. But there is a $300,000 per person guarantee fund in the state of New Mexico that people find comforting. Is Genworth, I mean, I don't think they're going out of business. They're going bankrupt, but their ratings have gone down. And so generally what I tell people is you're never gonna get, and I've looked at it, because I love to sell people new insurance, but it doesn't make sense. You're never gonna get that insurance, even with the price increases today, of what, you know, if you went out to buy new insurance, it just doesn't make sense. And I tell people, as long as it's not impacting your lifestyle, you know, pay the higher premium to keep the benefits.
On
For-
average,
for
what does it
sure.
cost, just roughly, you know, if you,
For long-term care insurance? Yeah, so
with
if
the,
you're
with
your
the death
mid,
benefit of $300,000, let's say.
so the hybrid approach, that's probably 5,000 a year, or depending upon your age and how,
Right.
70, maybe 75 to 100 in a single premium. Traditional long-term care, probably 4,000 a year, something like that.
Okay.
Just to give you an idea.
On the reverse mortgage, if you don't have a husband, but you have an adult special need child, can that be the person to stay in the house after you pass, or not?
Yeah, I believe so. I'd have to check into that for sure. I believe there's a provision for that, but I wanna get the correct answer. So after the meeting, I'll get your number and I'll find out, call you.
So you mentioned the state of New Mexico having something about this $300,000. So we have Genworth. So in 2 years, we're bankrupt. Now, are you saying that the state of New Mexico will require them to set aside $300,000 for us out of all the court filings and everything? Is that what you were saying?
No, so New Mexico for long-term care insurance and actually for life insurance too. First off, with life insurance and long-term care insurance, there's never been a benefit not paid even by companies that have gone bankrupt. The benefits have always been picked up by other companies who administer the benefits, take in premiums, pay claims, but that's not a guarantee. Just historically, the industry has stepped in and taken over companies that have had problems, and that's a very small, number of companies. But if Genworth did actually go bankrupt, they couldn't pay claims anymore, then the state of New Mexico, out of its own coffers, guarantees up to $300,000.
So that's like the FDIC insurance.
It is. It's like FDIC. And that's one reason you might say, well, why would the state of New Mexico ever allow premium increases? Why don't they protect their residents? Because they don't want to get in a position where they have to pay the $300,000, right? So, but a lot of people, because I've had people with Genworth in particular, other companies, John Hancock, MetLife, Prudential, they've also had premium increases, but not as much, and they're solid financially. Genworth has had bigger premium increases, and they're not as solid financially. But a lot of people find comfort in the fact that I'll at least get $300,000 if ever in a worst case scenario. As long as New Mexico doesn't go bankrupt, right? So
Is there a premium piece like in an FDIC? I mean, is there like a
premium on the,
On the
your
policy
policy
itself?
itself?
Yeah, the state of New Mexico collects premium taxes. And I actually don't know for certain if they use some of that money to put money aside, but they probably do. I don't know where they're coming up with the 300,000, but it is guaranteed by the state to protect the residents of New Mexico.
And then I was curious about the thing you had talked about earlier, where if you come to a point where these premium increases are getting more and more, is it true, or would it be true that it would be less, you're paying less to keep what you previously had than if you were to actually purchase a new policy with the same terms at that point?
Yeah, I've looked at a lot of those. People just even get mad at Genworth. I just don't want Genworth, you know, and I've looked at it, I'm like, you're gonna pay more for the same level of benefits. So, it's 98% of the time it's better to stay where you're at. I'd be happy to look at some of that for you and give you an opinion. But one thing I was gonna say is all long-term care insurance, traditional long-term care insurance, if they have a premium increase, by law, they have to give you other options to keep your premium the same. And the worst case decision, in a worst case situation, the very minimum that they can offer you is that you have a paid up benefit equal to the amount of premiums you paid. So if you paid $100,000 into the premiums, and you say, look, I just want to be done with this thing, I'm not making any more premium payments, I'm tired of this, then you do have a $100,000 long-term care benefit equal to the sum of premiums paid. It's not cash, they're not sending you a check, had that question, but they retain it, and if you need long-term care, you can at least get your premiums paid.
So the account won't close, the policy won't lapse and
Right,
close.
yeah,
If you stop making payments, say no more.
exactly.
But there's no appreciation in those payments you've made, like interest?
It's just a
Right.
flat number. Yeah, it doesn't account for the value of time that you've been making these premium payments.
Just getting old stuff is complicated.
My God, no wonder we got 10 billion people in government in DC with all these damn regulations.
Tell us what we should do.
Great, well, any other questions? Do you guys have any questions for each other?
No, there's a lot, thank you.
Yeah, thank you.
Likewise.
Or-
Great, well, if there's an evaluation on, yeah, give our panelists a hand, that's great.